I think we could go towards, just with knowing how volatile Bitcoin is, we could easily go up to 180 in that range, really rough ballpark. Wouldn't really bet on any of that. On the downside, now, if we're going to go into a complete liquidity collapse whilst we're in a business cycle collapse, we haven't really seen that in Bitcoin since ever. COVID, there wasn't really a complete liquidity collapse. There was a lot of liquidity injected beforehand. So if it breaks this model because of this crazy dynamic, then I think 30K is quite strong. That would be my two numbers, 37.5. And if we get a complete destruction, 30K.
Bitcoin is once again dancing on a knife's edge. As markets across the board grow more fragile, investors are watching closely to see whether the world's most volatile asset will defy the chaos or fall victim to it. With global liquidity tightening and business cycles showing signs of strain, Bitcoin's behavior in the coming months could define the next phase of this cycle. Could it soar to new heights on momentum alone? Or is a deeper shakeout brewing beneath the surface? Crypto analyst Willy offers a grounded take in the midst of the speculation. He draws from his CBVD model to identify price floors during times of distress. It's not perfect, but it's proven reliable through past crashes. According to Wu, if the market holds steady, we might see Bitcoin gravitate toward the $37,000 range. But if we're heading into a full-blown liquidity collapse, one that pulls everything down with it, the $30,000 level could be tested, and hard. There's no bravado in Wu's outlook, just data and caution. It's a reminder that in crypto, confidence often runs ahead of reality. This next stretch may not be about chasing moonshots, it may be about surviving the storm. Let's watch clips from Willy Woo's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
This is a risk signal, and what it's doing is it's measuring liquidity in Bitcoin, the buy-sided liquidity coming into Bitcoin. So we're measuring here the pretty much the capital flow coming into the network relative to the pricing structure to detect areas where there's strong liquidity, areas where it's weak, and you can see that that early in the cycle the risk drops very, very low, and late in the cycle the risk climbs. It's another way of saying that liquidity is starting to drop out of the market, and that usually means that the price becomes unstable, and then we're heading for a bear market until liquidity comes back. We saw it in this last cycle coming in here. It started dropping at the bottom of the bear. The risk started dropping, meaning liquidity came back in. And once again now, we're seeing this run up again. So that is a warning sign that we are late in the cycle, that the countdown timer for the market top is starting. And so, if we were to look at this here, that would have said, in the 2017 cycle, $2,500, yet it went to 20,000. So not saying, sell everything, it's the bear market now. It's just saying that the structure of the market is now getting less liquidity, more unstable. And so again here, it was actually when we broke 20,000. And here, we know it's coming. It's very hard to time the top, so I'm not going to do that. But I'll take you through to another view of it. This is another view of the liquidity model, but clearer for the larger cycle, because you can see here the risk model is kind of, you can trade it, and you can use it as a trading tool within sort of medium term, where the risk dropped down here, and actually it meant that liquidity was coming in on this upward swing. But here we go into the sort of the macro picture, and what we'll hear is we're measuring the liquidity in the market over the entire cycle. You can see that we actually we peaked its liquidity in December 2024, and it's been running down since. And generally, or let's say historically, every bear market started when we crossed this dotted line. And you know, even in the 2013 cycle, we had the double pump that crossed below. And again, at this top, it crossed below that dotted line. That's a 1.33 standard deviation. This is measuring liquidity and standard deviations from its norm. And so we actually have crossed that just a couple of weeks ago. And you'll notice that here, last cycle was very unique in that it crossed and it did collapse, right? And it started to collapse down into here and it was going very bearish. People were very bearish. And then actually paper came into the system and pumped it up. And so the paper in the system kept peaking. And this is a new thing because paper was only brought into the Bitcoin market at the tail end of 2017. This was the very first market cycle that we had the paper, the derivatives. And so it adds another sort of thing that we need to look for, that we're crossing in here. We're expecting a bear market coming, but we don't know how much paper's coming into the system, as in how much paper bets are buying in urgently. And so that takes us out to, you know, where we're poised. We do think that we're going to break all-time highs before the top. We expect another, I expect another move upwards, but, you know, we're running against the clock right now with the structure really starting to dry up. And so here we're going into a medium-term view. What you're seeing here is actually the capital coming into the network. You can actually see it here. You know, there's 2 billion at this level. Up here, it's getting close on $3 billion per day coming into the network. So you'll hear, you know, X 100 million came in last week on ETS. X billion came in with MicroStrategy per week. This is measuring all of it. And so some people get caught up with this idea of, wow, look at the billions coming in. And it's counterintuitive because when there's a lot of billions, you know, the inflow is really high. The chances of it dropping is more, right? Because the next day you're going to pump in even more capital. And price does not get moved by the absolute amount of capital coming into the network. It gets moved by the increase or decrease of that capital. So as you're, you know, only a few 100 million is coming in here, but you're increasing it, that's enough to lift price. And so I liken this to, and so we're presently in this sort of semi-bearish phase, but it has stabilized. The last few days have seen an uptick with this price rise. In the yellow, what you're looking at here is a leading indicator on this capital. And so this is more the speculative guys. And so we did get that bottom right there, if I zoom in a bit more. And we've seen a lot of speculative capital come in just recently. And so that pretty much called the bottom. That ticked up. And right now what you're seeing is a lot of speculative buying. But actually, overall, the flows are very neutral. And what that means is it's still a very tactical environment. We're not fully in a fundamental like tailwinds with a lot of capital coming in to support a massive bull run. But if this continues to climb up, you know, there's times where it sort of stabilizes here and then you get a really large run up in capital. That could still happen. We just need to be aware that there's a lot of profit in the books right now. I'll switch over to this view, the SOPA model, a good old-fashioned SOPA, which is really measuring the profits that's transacting between the new buyers and their old investors selling out. There's still a lot of profit in that activity, so they could actually dump and profit take to add more sell pressure. I'll turn that off and turn off the SOPA. And let's turn on, well, the purple here is the speculative oscillations. And so it's good that the amount of FOMO in perpetual swaps and futures is now tapering down, which is a pretty good setup for a run. And so that's good. That's healthy. It's not too much paper in the system. And so when this actually solidifies and we get the capital inflows, we'll be in a very good situation locally over the next month or two to run up. And also the yellow, which is the VWAP, is just my indicator of how overheated it is. And it's cooled down and it's recovering. So the oscillators are saying that we can do a swing up. The only thing that's missing is actually this capital flow to really come up. And then we've got a lot of profit on the books that could potentially dump, but they won't if the price is running up. So that's the situation right now.
Bitcoin's latest rally may look strong on the surface, but underneath, liquidity is quietly drying up. Capital inflows have slowed, speculative money is leading the charge, and profit-taking risk is rising. It's like watching a fire burn bright while the fuel runs low. There's still heat, but not much to keep it going. While short-term momentum could push prices higher, the foundation feels shaky. Until fresh capital steps in, the market is walking a tightrope between breakout and breakdown. Most people get altcoins wrong. They're not money like Bitcoin. They're tech bets, closer to startup stocks than digital gold. While Bitcoin aims to become a $100 trillion asset, altcoins collectively may top out around $15 trillion, and that's if everything goes right. Most will fail, as startups do. But the rise of stablecoins, especially Tether, is quietly rewriting finance. As Bitcoin scales, stablecoins could become more powerful than major banks, even reshaping global demand for US treasuries. The shift is already happening. Let's watch more clips from the interview.
There seems to be a misunderstanding throughout the whole industry what altcoins are, because they're not Bitcoin. Bitcoin is a store of value. For the most part, generalizing here, is that the altcoins are actually technology. You're buying technology. You can liken that to Silicon Valley startups. It's not all the money in the world, right? It's only a small part of all the money in the world. And if you look at Bitcoin at $2 trillion today and going to 100 trillion in today's value, that's a 50x growth ahead of it. Now, if you work out what altcoins are, 1.5 trillion, for the most part, excluding all the, meme coin garbage, that's casino. You could call that's entertainment, but there's GameFi, there's DeFi. Financial services is 5% of the world economy, roughly 5% of the market cap of public equity. So that's $5 trillion. And you layer on GameFi and other uses, you get to this figure at full saturation of $15 trillion. So you run that ratio of 15 trillion versus 100 trillion, and you will get somewhere around 85% like dominance of Bitcoin, because one basket is a whole bunch of technologies. And this is why you see the majority of altcoins die, because they're failed technology startups. 98% of startups fail, yet it's like 10 times worse, 100 times worse in altcoins, because the incentives aren't aligned. You can sort of exit scam. And so that's where we're heading to, but doesn't mean they're terrible investments if you pick the 1 in 1,000 coins that are going to win. Ethereum's 8,000x above its ICO. So that was one of the few winners out of all of it. And so, but I would leave that to the specialist guys that are inside doing that kind of pick. Generally the insiders, which really, the maxis will say, such as myself, is that's stacked against retail. If I'm an inside round, I'm buying, Solana at whatever it was, 50 cents. And then it runs up to $200. That's an unfair advantage, but that is the venture capital game, and that is technology. So that's the game in town. When we talk about altcoins in the short term, they are just, sloshes of capital moving in and out of Bitcoin. It used to be altcoins were great. When Bitcoin was going sideways, you can get more gains by rotating into the smaller bucket size, so the price would run up more. That kind of has fizzed in this cycle because, well, we've got treasury companies now growing the MNAVs, and those are the things that are running up. So they're getting competition on that front. But at the end of the day, it is technology and there is utility, not just stablecoins, but Aave's got $24 billion of value locked in lending. People are buying houses with it by fronting their collateral and pulling out stables and converting that into real dollars in a bank, to where the bank might have refused their mortgage because they didn't recognize Bitcoin as collateral. So there's value there. It's overinflated. We thought this was the new competitors to Bitcoin back when we were naive as an industry. 2017, there was the big altcoin bubble. You'll notice every single cycle is dedicated and never reached the same highs against Bitcoin. So I think it'll just continue to fizzle, right? It'll go up with the bull market and it'll fizzle. This one was a real fizzle because it's the third bubble and people usually learn by the third time. So yeah, ultimately, I think we're going to revert down to that ratio of like 85%, maybe higher, right? The 15 trillion of captured market, total addressable market, is on optimistic side. That's if they get a big, decent chunk of TradFi. If they don't, then dominance goes even higher. Long term. It'll take 10 years, 20 years to do this. Stablecoins are huge, right? They're effectively dollars. It's fiat running on blockchain rails, so it's 24/7. It's fast, and it really, really came into its own when, well, it was they invented because the whole industry was unbanked, debanked, and unbanked. So when you can't get a bank account, what do? You use proxy banking called a stablecoin. Originally, that was Tether. Tether solved the banking issue. Therefore, all the early exchanges, Binance, OKX, now Bybit, these really large exchanges that are trading billions per day, but most of the liquidity and volume is all trading against Tether because that's the other side of the book. If you're going to trade Bitcoin, crypto, anything, you need Tether on the other side of the book. It's not US dollars, right? So as Bitcoin grows another 10x from 100,000 to a million, then AUM inside these stablecoins is going to go another 10x. So like you can see that has consequences. That means Tether growing 10x will be more profitable than the top 5 banks put together. Bigger than the top 5 banks put together. So they will own banking. The other thing is that they will displace US treasuries, all of China, all of Japan, who are not buying it anymore and selling. And so suddenly you're in a situation where the US dollar is effectively propped up by the debt owned by the stable coins within Bitcoin because it's all driven by Bitcoin. So it's interesting where Bitcoin, if you pan this out, Bitcoin $1 million, Bitcoin starts to control, the dollar in terms of the debt. Who's buying those US treasuries? So that's all I've got to say with that. Jan?
Bitcoin's climb past $108,000 has captured global attention, and forecasts like Standard Chartered's $200,000 year-end prediction are only adding fuel to the fire. With ETF inflows accelerating, corporate treasuries stacking sats, and potential regulatory tailwinds in the US, the bullish momentum seems unstoppable, at least on paper. Yet beneath the surface, the story is far more nuanced. Price might be rising, but liquidity, the real lifeblood of sustained rallies, is thinning out, and that's the part most investors overlook. While major institutions rush in, market structure tells a different tale. Liquidity inflows peaked late last year and have been declining since, a setup that has historically signaled incoming volatility or cycle tops. This aligns with on-chain analyst Willy Woo's recent breakdown. Liquidity stress, rising speculative activity, and a thinning capital base all point to a market approaching exhaustion. It doesn't mean a crash is imminent, but it does suggest the next leg up will require far more fuel than the last. Even as Bitcoin approaches new all-time highs, the capital required to push it higher increases exponentially. If institutional flows stall or retail enthusiasm wanes, the price could drift or correct sharply. Meanwhile, the stablecoin ecosystem, especially Tether, continues growing in lockstep with Bitcoin, increasingly intertwined with global liquidity. As bullish as the headlines are, the deeper signals suggest we're racing the clock. The setup is powerful, but this rally's staying power will depend not just on speculation, but on sustained, fresh capital willing to push it even further. As we wrap up, do you think stablecoins and Bitcoin will become the default store of value in struggling economies? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.